Well, today the conversation is about fixed rate mortgages versus variable rate mortgages, advantages to variable rate mortgages that you may not know about, because the common wisdom is 5-year fixed is sort of the standard mortgage term that people look at. Well, first thing you need to know is where they come from. Fixed rate mortgages are tied to the bond market and bond performance. Variable rate mortgages are tied to the Bank of Canada rate and its fluctuations up and down. That meaning with a variable rate mortgage means that your mortgage isn't going to fluctuate month to month, only if the Bank of Canada raises or lowers their lending rate, their prime lending rate. The third thing you need to know about both types of mortgages is where the advantages and disadvantages come in with regards to penalties. The crappy reality is that about 80% of mortgages, thereabouts, will renew before the end of term, meaning if you break that mortgage, there's a penalty to be paid, and the differences can be substantial. In a fixed rate mortgage, if you break the mortgage before the end of the term, average penalty, this is an average, it's not exact, is about 4.5% to 5% of your mortgage balance. If you are in a variable rate mortgage, you're looking at a 3-month interest penalty. So the difference between those could be in the tens of thousands of dollars, depending on the size of your mortgage. But with a variable rate mortgage, there's 3 key advantages that I don't know if people talk about often enough, or if it's even presented to people often enough. The first big, in today's environment, the first big advantage with variable rate mortgages is that there is short-term savings, meaning variable rates are lower than fixed rates by and large right now. So you can take advantage of fixed or variable rate savings until the Bank of Canada does something with its interest rate, which for the foreseeable future doesn't look like much is going to happen. The second thing is flexibility. You can lock in, take advantages of the savings short-term in a variable. And if rates start to climb and you feel uncomfortable and you want to lock your payment in, you can lock your payment in at the best rate that lender offers at that time. And the third key advantage is the penalties that we just mentioned. Penalties in a variable rate mortgage, 3 months interest charge. So why is this important? Because if you know you're going to be taking equity out of your home in the next 3 or 4 years to purchase a rental property, investments, renovations, helping kids through college, whatever that might be, and you have to break your mortgage, a variable rate mortgages offers you the advantage of a 3-month interest penalty versus 4.5% to 5% of the mortgage difference. You can see where that could be a pretty substantial savings. It all comes into your mortgage strategy. It comes into your long-term financial goals and how you want your mortgage to fit in there. And we'd like to discuss all of that with you when we sit down and talk about your overall mortgage program. Hope you found the information valuable. You can find me on YouTube at Joel Scott. You can look up, we've got over 50 different mortgage related videos there, and you can find a topic that may be suitable to you. If you found the information useful, please share with a friend. And if you have questions at any time, reach out. Thanks.